My guest today is the wealth manager and commentator Tim Price. Tim began his career in investment banking in the 90s and has since gained nearly 30 years' experience in capital markets. He's published 2 books, The War on Cash in 2015 and Investing Through the Looking Glass the following year. And Tim also founded Price Value Partners, a company which looks after investment portfolios for private clients. He's an avid writer and podcaster. His State of the Market podcast is well established and has built a loyal following. And Tim's well known for his strong, well-articulated views on monetary policy, investing in gold and silver, cyber currencies, and other alternative investment strategies. Tim, good to have you in the studio.
Good to be here, thank you.
First, off the bat, what did you think of the budget in light of today's growth numbers?
It seems to me that the Conservative Party and Rishi Sunak have completely lost all connection with their source code. This is not a Conservative Party I can recognise, I'm afraid.
So you thought it was too big spending, not enough even talk of tax cuts,
Correct.
And too much reliance on growth assumptions?
It's like we all ended up voting for Jeremy Corbyn.
Now, what you've written about lots over recent years, particularly in light of quantitative easing, is investing in gold, silver, and so on. How strong do you think the case is for those kind of investments?
So let's give you a ratio that we've been looking at quite closely over recent months. There's something called the Constant Commodity Index, which is just a basket of commodities, relative to the S&P 500, which is the broad US stock market. That index, that ratio, has never been as cheap in commodities' favour for 60 years. To put it another way, commodities are disgustingly cheap relative to listed companies in the US, big, large cap, mega cap companies. This is probably the most compelling opportunity I've seen in my life.
So you say that the ordinary stocks and shares, S&P 500, FTSE 100, FTSE 250, those share prices have been pumped up, have been bloated, partly by quantitative easing, central banks increasing their balance sheets. And that means that the prices that investors can buy commodities like oil or current precious metals like gold and silver are, in relative to equities, particularly cheap.
Correct. And I wouldn't even say that let's say the FTSE or the other European indices are that expensive, but the S&P 500 has been the one-way ticket for the last 12 years. The one decision you had to make was just buy US stocks and buy the FANGs, the Facebooks and Amazons and so forth of this world. But now, in light of the money printing to which you refer, we've got inflation baked into the pie now. And our view would be that if you want to hedge against inflation, or for that matter, try and exploit it, then probably the best way of doing so is through things like precious metals and shares of precious metals companies.
If somebody wants to, we don't give investment advice, certainly not on national television. I'm certainly not qualified to do that. But in general terms, without being specific, if somebody wants to invest in gold and silver, what's generally the best way to do it?
The way we look at this is that we like to build a diversified portfolio. It seems to me that there are so many risks out there on the market that you can't be too diversified. So one way, the starting point really ought to be to build a base platform of the metals themselves, the commodities themselves.
To buy the physical metals.
To buy the physical metals. And that's the purest way of ownership. And thereafter, depending on your risk appetite, you can build in maybe exposure to large capitalized, well-capitalized, diversified mining companies. And then if you have the risk appetite on top of that, maybe look at some of the more junior, smaller cap, more speculative companies. We don't tend to speculate. We like companies that have solid cash flow, have little or no debt, but irrespective, we like to have a spread of assets.
Now, I do enjoy your investment newsletters. You often take a sort of historical turn in what you write. Just put in context for viewers, we talk about quantitative easing quite a lot here on The Money. I personally think it's the most important and most controversial economic policy of the last 2 or 3 decades.
Yeah.
It's woefully under-commented on in the mainstream press, in my view. And I know you, as I have done, tried quite hard to correct that by talking about it a lot. But in historic terms, how unusual is it that the big central banks of the world, the Bank of England, the Federal Reserve, the Bank of Japan, have doubled and tripled and even quadrupled in some cases the size of their balance sheet, what we call the base money supply, in response to the 2008-9 financial crisis?
We've simply never been here before. So to give you an idea of the historical context, 25% of all the US dollars that have ever existed were printed last year. Interest rates have not been this low in all of recorded history. In 5,000 years, interest rates haven't been as low as they are now. If we're not in la-la land, then I'd like to know what la-la land looks like.
But it's not just about printing physical dollars, is it? It's about the central bank expanding its balance sheet, using just keystrokes on a computer.
Sure, this doesn't even exist in physical form. It's purely digital.
That's right. And so what are the potential dangers? Because again, you and I have talked about this for a lot. And let me try, over many years, let me try out this idea on you. I would say that pre-pandemic QE remained largely within the banking system. The central banks created money. They bought gilts and other bonds off the commercial banks and the investment banks, helping the investment banks to recapitalise. The investment banks then put that money back at the central bank so they looked stronger as reserves. What's happened post-pandemic is that QE has created money which has been used to buy government bonds, and the government has then just spent the money. So it's getting out there in the economy rather than being locked up in the banking system like pre-pandemic QE was.
I think that's a very important point. I think the other thing I'd add is that the so-called independence of the central banks is now in question because governments are almost directly impacting the economy directly through fiscal activity. So QE's...
Which is political, right?
QE's huge, but now the central bank's kind of been tossed aside and the government's now just doing it all itself.
And do you think that part of the reason we're getting inflation, and we're up at 3.1% now, even the OBR is looking at 4.5% next year, the Bank of England's acknowledging that its previous notion that transitory inflation was all we had to worry about, it's actually going to be a bit more
We've just had a
persistent.
6+% inflation print in CPI in the US.
Absolutely, 6.2%, the highest for 30 years. But do you think part of the reason for that inflation is that quantitative easing money is now getting out into the economy, being spent over and over again, and we're in a classic too much money chasing too few goods situation?
I'm sure that's the case. Inflation tends to be somewhat misunderstood. As let's say a classical economist, I'd argue, I'm not an economist, but from taking a sympathy to the classical perspective, inflation is an increase in the money supply. What happens to the price of goods and services is a second order impact, but the inflation's already there now.
Yeah.
The only question is how long it takes to get to circulate.
So where do you think inflation could go, Tim? I've noticed over the years you use quite strong language, but you're very measured. You have a real reverence for numbers. You're not just going to pluck a number out the air. So where do you think inflation could go? 6, 7%?
I think there's a risk that we could yet re-experience the sort of stagflationary levels of the 1970s, and that's double-digit inflation.
Double-digit inflation combined with a stagnating economy.
Combined
that's
with
what
suboptimal growth, which is a disaster.
So how pessimistic are you about the UK economy then? We've just had a panel with 3 leading commentators. We ended up at the end of that panel broadly optimistic, though all of us were sceptical. Well, Julian Jessop wasn't, to be fair, about the Chancellor's growth assumptions of 6.5% this year, 6% next year. What do you think about those growth assumptions?
We don't have forecasts for growth per se. We tend to look at bottom-up valuations in individual stocks globally, so we're not sort of big GDP-focused sort of players. What concerns me is the damage that's being done to the economy on the ground, particularly to SMEs, and a lot of the SMEs,
small and medium-sized
companies that won't necessarily even be a feature of the stock market. So it's difficult to see what's happening to them, but we just know that one of the effects of the pandemic has been a lot of people have lost their livelihoods.
And it's those SMEs which really drive the UK economy, right? They employ 2/3 of our people.
They also drive jobs growth, as you've just said. So where the SMEs go, where the UK economy goes.
Yeah. Now, I introduced you as somebody who is concerned about a bond market crash. What is a bond market crash, first off?
So the bond market, again, is a kind of somewhat almost an orphan asset in the context of global capital. So people know about the stock market because everyone's always banging on about it.
Because it's the companies, it's stocks and shares of companies.
Exactly, it's all the sex and violence in the stock market. But the bond market is actually what drives things like interest rates in the real economy. The bond market basically consists of IOUs issued by governments, to a lesser extent corporates, and ultimately even household debt packaged through the mortgage market. The problem, I think a lot of the problems of today derive from problems that were not addressed in 2008. In 2008, we had a financial crash. The banking system was effectively bailed out, but some of the things that should have been reset then were simply kicked into the long grass. So I think the sky is now darkening with chickens coming home to roost from '08.
So you think there's too much debt out there? You think the price of that debt has been pumped up too high
through QE.
by quantitative easing? The corollary, viewers are just going to have to believe me on this one, of a high price of debt is a low yield on debt, low interest rates. And you think that in the end, because there's so much debt out there and because QE has warped the market for debt, those bond prices could collapse?
Yeah, in a word, yes. So basically, the bond market's like a Potemkin village. It's not. The prices aren't real. The one iron law in finance is that if interest rates go up, bond prices go down, so that the yield can adjust to current market rates. If bond prices go down, we haven't seen a sustained bear market in interest rates for 40 years. Nobody in any dealing room alive has had the experience of
constantly
sustained
rising
bear market, i.e. rising rates. And so there's an incredible problem for central banks, including the Bank of England. They can't realistically lower rates anymore to stimulate the economy, but they can't raise rates to suppress inflation because that will crash the housing market and the bond market and probably the stock market. So they're boxed into a corner. I wouldn't wish being a central banker on my worst enemy right now.
Without wishing to scare people too much as they sip their tomato soup and eat their lunchtime sandwich, so how can we get out of this? What do you think will happen, Tim?
I think the prudent course of action, the pragmatic course of action for any investor is, again, as I said earlier, to be diversified more than you've ever been before, and to use a lot of real asset protection, use inflation protection wherever it can be found. And that involves real assets and cheap stocks, high quality companies you can buy cheaply. And
looking forward, let's talk a little bit at the end of this interview about the shape of the world. You and I both grew up in the UK. The UK is still, the fifth, sixth biggest economy in the world. It's a major player. But a lot of the action, the centre of economic gravity,
go to Asia,
is shifting east. To what extent is that reflected in your investment portfolio? To what extent should our viewers be thinking about that shift in economic gravity, centre of economic gravity, towards the emerging giants?
Suffice to say, in terms of country market exposure, we've got our main priorities are countries like Japan, to a certain extent Vietnam, Australia, through the mining sector specifically. The growth in the next 10 years is going to come from predominantly Asia. It's not going to come from Europe, because I think Europe's arguably already in recession. UK, okay, fairly priced market, but you go east, young man, for your growth.
And let's talk a little bit more about precious metals. Where is the price of gold in a historic context? And to what extent do you think it's a safe rather than a risky investment as inflation is rising?
I mean, gold got to as low as something like $250 20 years ago.
An ounce.
Sorry, an ounce.
Yeah.
And then we were at just under $2,000 an ounce a while back, and we've been in a sort of sideways market for some years now. I think gold could quite easily it's above 1,800, I think, as we speak. It could easily regain that $2,000 level. I think it's going way higher in the medium term. But the question is not what gold is worth in dollars. The ultimate question is what's the dollar worth? And in extremis, and ultimately, all paper currencies derive to their core value, which is nothing.
But the US is the world's reserve currency.
For sure.
So it has that kind of flight to quality.
It'll be the last man standing.
Yeah.
But notwithstanding that, I think we're probably in the middle of some kind of historic monetary reset. So you can understand why a lot of investors and also central banks are quietly accumulating gold now.
And in the end, it's those base metals which have that inherent scarcity, that intrinsic scarcity value, that will hold their worth as paper currencies come under threat.
Basically, you can't print gold. You can't print gold. You can't print silver. You can very easily print dollars, pounds, euros, and yen.
You can't print Bitcoin either, can you? Or other
You need all kinds of computers and servers.
But there can only ever be 21 million Bitcoin. That's the whole point, as opposed to a lot of these central bank-derived digital currencies that they're talking about.
So we haven't taken the plunge with crypto yet, but it's still something we're keeping an eye on.
But so what would you say to people who are looking, again, we're not giving specific financial advice, but in principle, do you think cyber currency could be a useful store of wealth, or is it just a phase,
At the moment,
fashion?
it's too volatile to be considered a store of value. But as far as taking a long-term perspective, I think it probably makes sense to keep an eye on the market.
Tim, it's been great talking to you, as ever. Really enjoyed having you here on the show.
Been a pleasure.
Tim Price there of Price Value Partners. And I think we can bring you some more emails here. No, maybe we can't, so we'll leave it there. Great to be with you here today. This is it's been great to talk to Tim Price. We've had a debate on GDP here in the UK. GDP is slowing, but we're still hanging in there. There's still some senses of a UK recovery. This is GB News. I'm Liam Halligan, and that was On the Money.